Okay, good morning and welcome back everyone to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And excuse me, we have a pretty, I would say, packed slide deck to go through here today because had a pretty big knee-jerk reaction here in the markets yesterday. This was fairly expected. This is what we talked about on Tuesday of the fact that markets were overbought. There were quite a few of the sectors that seemed quite stretched to the upside, and we were expecting a pullback, and we got that pullback in a single session. And this is exactly what we warned investors about regarding that pullbacks tend to be very short and violent. That's what we saw yesterday. And the question right now is whether this is a buying opportunity or this is the start of a larger correction. So today I want to unpack a lot of charts to discuss these two possibilities and understanding as to how we should go about positioning in the markets going forward. So let's go ahead and get started. Before I do, just a quick disclaimer: what we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So first and foremost, we're back at 300. This is the level that we've been talking about since October of 2019. We've been talking about this as a major resistance level back then because it was about to break out from that level. We had that breakout in late October, rallied all the way up to 340, and then came back to retest 300 as support. It was resistance again back here in late May before it finally broke out above it and then went a little too far too fast. And that's exactly what we talked about on Tuesday. So we got the correction that we were looking for. It happened, I would say, a little quicker than probably what most of us had expected. But again, that is the new norm that we currently are in, is that we are markets will continue to march or grind higher at these paces and then have very quick and fast violent pullbacks. So short opportunities are extremely short-lived, and you certainly can try to position for them. They're difficult to trade because you have to time them very quickly or else they stop working immediately. And the trades, if you do catch a short like you did yesterday, you have to take profits very, very quickly. So for some of you that may have put on some shorts yesterday, you might find yourself this morning for those trades to be looking, substantially different because markets are already starting to bounce higher. So the question that we want to answer is, do we buy this dip, or is this the start of a broader correction? We'll take a look at some of the commodities because some of the commodities have been driving some of the interest in some of the names. So I wanted to take a look at that, especially for energy and some of the mining stocks. I want to take a look at defensive versus cyclical because this is what we spent all of our time on Tuesday talking about. We talked about all the different sectors. We looked at which sectors were overstretched and overbought, and those were the sectors that we saw the biggest pullbacks here yesterday. And then we talked about which sectors were least overbought and least overstretched, and those are the ones that saw the least pullback yesterday. So we want to look at whether or not we think this is going to continue. We want to explore some of the ideas that we have as a result of yesterday's pullback. Yesterday's pullback predominantly was a market's weariness regarding the resurgence of COVID-19. As to why yesterday the market decided to pay attention to that, even though it's been something that's been on the radar for a couple of weeks now. No one knows, but that's the new reality that we're currently trading. At the very end, if we have a few minutes, I'll try to answer any of your questions. So let's go ahead and get started. Like I said, I have a lot of charts to unpack here, but the question that we're trying to answer again is, do we buy this dip? Is this an opportunity to buy the dip again, or is this potentially the start of a larger correction or structural correction in the market? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. My background heavily is in technical analysis, so I'm going to use the charts to help you understand how I'm viewing the markets and why I think that this is potentially more of a buy the dip opportunity rather than a structural sell-off. But I will also try to point out that, certain levels that we need to keep an eye out for, that if we break below, how we want to position for those. But as of right now, the market's, back at 300. This was the major level that we've been talking about since late last year, 2019. We tested 300 multiple times before finally breaking out. So we finally broke out, we broke below this level, came back to retest this as resistance, and we finally managed to break out above this level. And this was a level that we've been talking about for a long time. And yesterday's sell-off came back to retest that level to the penny. So what's fantastic about this particular trade is that you basically have a very good risk to reward for a long setup. And that's exactly what we're seeing here as the markets have bounced off that 300 level already. We're up about 7 points, 2.5% off that 300 level. These are, from a risk to reward perspective, great for longs, because if it breaks below 300, you're only risking about, in this particular case, 9-10 points on the SPY in order to say that I'm wrong on this trade, cut your losses and move on, versus you still have quite a bit of upside if this market rally continues. So your risk to reward just from a stock perspective is great, and those are some of the ideas we want to explore here. Now, I will say that positioning, we went from what we would consider a severely, or not severely, but overbought conditions. This is what we warned everyone about on Tuesday. We were warning about a potential pullback. We got that pullback, and now, as you can see, the RSI is substantially below the 9-day moving average, which again is now an oversold condition. So now we're looking for buying opportunities. Now, some people will say that this particular blow off, this candle that we got here yesterday, looks very similar to the gap lower that we saw here on February 24th, which began a much larger structural sell-off. But markets are in a much healthier condition than they are back then. We have much stronger support in terms of this particular rally. We've seen this rally. We see healthy sector rotation. We see broad market participation. We have small caps joining. We have equal weight joining. We have both defensive and cyclical. So this is really supportive of why I believe at this point, with the information that we have, is that this 300 level is another buy the dip opportunity rather than the beginning of a larger structural sell-off. Now, I will say that if SPY breaks below 300, things do change. If we break below 300, then I do think that we have the ability to retest that 285 level. But as of right now, we've held both the 20-day moving average, the 300 level, which is also holding the weekly 20-week moving average. So all of this, again, short-term over the next few trading sessions is supportive of a broader move higher. If we look at technology, so the NASDAQ 100 index broke below 10,000 on that last push right before on that high. Came back to retest that. As you can see, one of the things that we brought up on Tuesday was that the move in the NASDAQ 100 has been extremely orderly. It's not like the S&P where it kind of moves sideways for a while and then goes parabolic. It's been very orderly. So what we've been finding is very structured buying opportunities every time it gets near that 20-day moving average. So that's exactly what we see today's price action to be as well. So NASDAQ 100 also looking fairly supportive of a buy the dip scenario. Equal weight S&P 500 index did pull back quite a bit as well, but at this point right now, it's still holding that 20-week and the 200-week moving average, which is good for the long term. It did break below the 20-day moving average, but as long as the weekly moving averages stay above their support levels, this again provides a good buying opportunity. We actually, if you look at the statistics and probability of when the stock moves below the 20-day moving average, but it stays above the weekly moving average, that gives you a very high statistical move to the upside. So again, we are basically moving from overbought to oversold now on a very short-term indicator and looking for opportunities to go long. And again, these long opportunities, this is not to say that markets can't correct, but if they do correct, you have a very short window, or you have a very small window where you can cut your losses and take on a very small amount of loss while still maintaining a very large amount of upside if the markets do continue to move higher. So that's part of why we prefer, from a risk to reward perspective at this point, to go long versus outright taking any type of short positions or positioning for continuation lower. The IWM Russell also this is the weakest of all of the indices because the Russell is testing the 20-week moving average. It's still below the 200-week moving average, but small caps have been particularly strong since April. So we have seen some pretty large structural pullbacks in IWM or small caps that have been supportive of a buy the dip. So we're still also looking at that same opportunity here in IWM. So broad market, no matter how you slice and dice it, what sector you look at, what equal weight versus market cap weight, small cap versus large cap, we're seeing the same type of charts. And so what this shows us is that the markets are substantially healthier than where they were back in February, where we did see the same type of gap lower that caused a much bigger continuation lower. That's not the expectation at the current moment. Now, VIX did break above that 20-day moving average, which is something we also talked about on Tuesday as a major thing to keep an eye out for. So the question right now is whether VIX will remain elevated. This may change some of our views in terms of what option strategies to take. So when we look at option strategies, when volatility is high, we prefer more to sell strategies than to buy. So we're at this point still evaluating kind of how we want to position from an options perspective. And I'll get into some of those as we talk about the specific ideas. Now, Crude did find some support. So on Tuesday, we talked about how Crude found resistance at 40. And this was our thesis that an energy would pull back fairly strongly as a result of hitting this resistance level, and that's exactly what we saw yesterday. Energy was down almost 10% versus the other sectors were down about 8 to 7% on some of the more cyclical sectors. So energy now finding a little bit of support here around 36.5 or so. So perhaps this might stem some of the declines here in energy, and I believe energy pre-market is one of the larger movers to the upside today. So energy perhaps stemming this move to the downside, but with that $40 resistance here on energy, if it breaks above 40, certainly much more bullish here on energy, but really I wouldn't necessarily think that I would go long energy unless Crude could manage to break back above 40. I did want to take a look at gold because this is something we've been talking about for quite some time. Gold has spent now a very large amount of time between 158 and 164. Basically, we broke into this range back here in early April, has been range bound since then. And the question is whether or not this is now primed for a potential breakout to the upside. From a trading perspective, if you think about the amount of debt that has been pushed into the markets and investors using gold as a hedge against inflation, that could be a fundamental thesis for why gold would break out. From a technical perspective, you have a very nice looking chart setup that if you do break above 164, you have what could be a nice continuation higher by probably another 10 points to the upside. So gold is certainly on our radars right now. Again, break above 164 would be significant. So now that we talked about the broader market, let's talk a little bit about the individual sectors. So again, when we talked about the sectors on Tuesday, we spoke about the cyclical sectors, predominantly industrials, materials, financials, that really just went a bit parabolic, a little too fast. And we said that these were the sectors that were at risk of the biggest pullback. And that's kind of exactly what we saw versus the staples and utilities. As you can see, both of these sectors never reached overbought. They didn't go parabolic. And these were the sectors that did not pull back as much. Also communications, we talked about, similar to technology. What we really thought was fairly constructive about the communications and technology chart was that the move higher was much more orderly. You didn't see this type of sideways movement, then followed by this parabolic move to the upside. It was a very orderly chart, just like technology, like the NASDAQ 100 index. So these were the sectors that did see some of the smaller losses yesterday. These all pulled back to that 20-day moving average, which again has been a consistent buying opportunity for quite some time. And it's yet to see as to whether or not we might see that continue later on today. But early pre-market trading certainly seems to suggest that this 20-day moving average as of right now is going to hold. The question is whether or not we're going to continue to push to the upside. I will say yesterday's price action certainly puts a continuation higher more into question, which is why also along with the spike in volatility, we may start changing our strategies here. As opposed to pushing for a significant move to the upside, we might be pushing for more of a modest move to the upside here going forward. But technology is certainly one of these sectors. Staples and the defensive sectors is certainly one of the winners rather than more of the cyclical sectors. So as you focus on ideas after today, from my perspective, I think it makes more sense to focus a little bit more on the sort of defensive names, especially if you think about why the market sold off yesterday. The markets were concerned about the resurgence of COVID-19 cases. So we had a shift over the past 2 weeks where lockdown stocks were not performing as well and reopening stocks started to perform much better. We started to see a reversal of that yesterday. So the question is whether or not that's going to continue. And my take is that I think that we're going to see a bit of a surge back into some of the lockdown stocks. And if you think about stocks like Dollar General, why did those stocks stay put yesterday? Because those are stocks that will do well if, let's say, lockdowns end up a little, or social distancing ends up being significantly longer than we had expected. Zoom also, staying relatively put yesterday. So these types of stocks did fairly well yesterday, considering the fact that the market sold off, almost 6%. So defensive at this point, I think, is the play right now. So some of the names that I want to show to you are within the staples sector, the communication sector, the technology sector. These are sectors that we think are better plays for this particular bounce, rather than the more cyclical sectors like consumer discretionary, which may have seen a bit of a temporary top at the moment. So on the semiconductor stock side, what I wanted to point out is Texas Instruments. What I like about Texas Instruments is that it didn't break out to all-time high. So we're not shooting for the moon at the moment. We're just shooting for it to get back to its all-time highs here around 132. It had that nice parabolic move, pull back to the 20-day moving average, and now we're looking for potentially a continuation back into that 132, 135 level. Now, Texas Instruments predominantly is going to be a beneficiary of the consumer electronics that many of us may need or want over the next few months, as we may extend our work from home or maybe completely structurally shift the way that we work. And I certainly think many companies are starting to think along those lines as to whether or not they need employees in the office all the time, and perhaps buying computer and electronics to help their employees work from home. Texas Instruments predominantly making a lot of the chips for the small consumer electronic items that you might need, such as webcams, mouse or laptop keyboards, things like that. So that's why this is one of the semiconductor stocks that have been doing quite well over the past few days or past few weeks. And the pullback that we just got yesterday provides a better entry opportunity for a continuation higher. Now, this is really where we need to start thinking a little bit about option strategies. So when we look at a symbol like Texas Instruments, the question is whether or not we go out and buy calls and call debit spreads. For those of you that joined us yesterday afternoon for our education session, the question is whether you go out and buy some calls, or if you use a call spread like a debit strategy, some similar to this. Now, right now, these are pre-market spreads, so they are fairly wide, but the question is whether or not you want to utilize a buying strategy, which does require the stock to make a big move to the upside in order to break even. Now, usually on a buy the dip strategy, you might see a big move to the upside, but with volatility being a little higher, these calls and these call spreads are starting to get a little bit more expensive. So they're not very cheap. As you can see, the OptionsPlay score here is actually relatively very average at 87, telling me that buying these call spreads are very expensive, versus you might want to explore taking a look at selling some put spreads, something like a 125, 115 put spread. As you can see, also, this doesn't particularly look very attractive because you are collecting exactly 1/3 of the width of the vertical spread here, which is the bare minimum that we're seeking for. Usually we like to get closer to about 40% of the width as opposed to 33% of the width. So this is the question right now as to how do you position for this market. Now, statistically, we do have a pretty good probability of the move higher, but at this point, I'm a little bit more concerned as far as the magnitude, as far as how far these stocks can go. And the more expensive these calls and call spreads are, the less attractive these strategies are, because we might not be expecting the same type of magnitude move as we did expect when it first broke out above those ranges. So that's how we're starting to rethink our strategies as to, do we still continue to buy vertical spreads like we did over the past couple of weeks? And that really has saved us during yesterday's sell-off, because we're risking a very small percentage of each stock's price. So everything from Cisco to AT&T to Workday, we all use debit spreads, because for those of you that joined us yesterday, debit spreads allow us to take these directional moves when we expect a fairly large magnitude move, but we know that there's a relatively high probability of a pullback, and we want to make sure that we protect ourselves if and when that pullback happens. And that's exactly the type of strategies that we deployed. Now that we did get that pullback, the question is what strategy is best? And this is really where we think that you need to start considering shifting from strategies like debit spreads to potentially looking at some more credit spreads, or maybe a bit of a combination of both, depending on which sector or which type of stocks that you're playing with. So Texas Instruments, one of the stocks that are on the buy the dip list for us. It's in the technology space, which certainly is more of the stronger sectors that we're paying attention to. Big tech, also Microsoft. If you think about working from home being a far more is something that's here to stay, big tech names like Microsoft are certainly going to be net beneficiaries of this through both the Microsoft product that they sell and as well as the cloud services that they provide, the competition with Amazon. As people continue to work from home, cloud needs are going to increase, and this is all supportive of stocks like Microsoft and Amazon. So the fact that Microsoft, after this kind of parabolic move, has now pulled back to its 20-day moving average provides more of a buying opportunity. Again, this type of move, I'm not sure that I necessarily expect Microsoft to make a big move higher. We'll see over the next couple of days, but I'm more inclined to sell premium here, especially if you're unable to find a put credit spread that is able to profit as long as Microsoft stays above this 186, 188 level, which is my base case at the moment for some of these types of stocks. Another trend that we continue to see is having a net beneficiary as a result of COVID-19 is really more of an environmental friendly type stock. So if you look at Beyond Meat, you look at the meat industry, there's been a lot of movement towards not eating meat from an environmental perspective. So stocks like Beyond Meat obviously have been doing very well. This stock has gone parabolic over the past few months, but every time it gets back to the 20-day moving average, it's becoming a buying opportunity. Again, not sure how far Beyond Meat can go, but 140 certainly seems to be a pretty solid support here at the moment that has contended for quite a few weeks now, has now broken above it and retested as support. So a continuation higher is expected. Again, Beyond Meat options are not cheap. So when you look at these options, you might say to yourself, well, do I think that this stock's going to make another $15 move to the upside because call options cost $17, call spreads cost $14, and you say to yourself, do I think the stock's going to make another $15 move to the upside in 45 days? And I would say yes, but if it makes a $15 move, you're just breaking even here. You're not making any money on the strategy. So on these types of trades, I'd be more inclined to seek opportunities like selling a put credit spread where I'm selling maybe a 144, 130 put credit spread, something along these lines, collecting a fair amount of premium here. Now, these are pre-market or after hour spreads, so I wouldn't quite go off these quotes. I would look at this when the market opens, but again, I'd be more inclined to sell premium rather than buy just because of how expensive buying these premiums currently are. Another trend that we are currently exploring is really this concept of reshoring. So we all know of the term offshoring, moving your production and manufacturing to countries that are cheaper, and from a manufacturing perspective, we've been doing that for the past 2 decades or so. Now, as a result of COVID-19, we've seen the risk to that type of strategy in terms of when we move a very large percentage of your manufacturing in certain industries offshore, and the risks that come along with that, especially when you have geopolitical tensions rising as a result of that. You're going to see more of an investment to reshore, meaning moving some of that manufacturing and automation back to the US. And Rockwell Automation, one of the key players in this particular space. What I like about the stock is that if you look at a long-term chart, you have a very nice breakout recently, came back to retest that breakout level as support, and that could be potentially the level that you want to shoot for a long-term move higher. Again, risk to reward just from a stock perspective here, it looks very good because you have a fair amount of upside here from 200 to 230, and if the stock drops even another 10 points down to 200 or so, that might be an indication that this stock is not going to rally, and it's certainly going to be a time to get out. So you have a fairly small amount of risk to the downside to get out while you still have maintaining a fair amount of upside here. So same thing here in names like Rockwell Automation. calls are not cheap, right? So trading at 206, $16 call option, $14 call spread. So the stock needs to move 16 bucks to the upside just for you to break even. You know, that gets you pretty much back to the all-time highs here. So not a lot of room to the upside, even if it gets back to the all-time highs of 230 or so. Not bad on the call vertical here. And again, this is based on after-hour bid-ask spreads. But even as you can see, even at the midpoint, it's still pretty expensive. But you know, if it does get back to that all-time high, you're looking at 135% return, not bad. But depending on how much premium you can get on the put spreads, you might want to also explore what that looks like selling premium rather than buying premium here. So now what's difficult here is the fact that there are not a lot of options here. So Rockwell Automation does not have weekly options, which makes it more difficult. And you certainly can't find an at-the-money strike because the only strikes are 210 and 200. So in this particular case, probably more likely to be buying options rather than selling options simply because of the strike prices. And maybe you might want to avoid this because you can't find the right strike prices. Many times that is a reason to not trade something. You might really like the setup from the chart perspective, but maybe you just can't find the right options to trade. So that's the line of thinking that we currently have with the market, is that markets are substantially healthier than they were back in February. We did get a blow off yesterday that resolved a lot of the overbought, the negative divergence that we saw in the market. It did happen a little quicker and more violently than we expected, but that is now unfortunately the new norm, that where we have weeks on end of markets marching higher, followed by 1 or 2 days of violent sell-offs and then a resumption of that. The question is really how strong will the markets come back, especially given the concerns that the market sold off under yesterday, and whether those trends will continue to be a concern. So I do think that it's good to keep a track of all the COVID-19 trends that you currently see in terms of states. If there are more states that start to accelerate in terms of number of cases, that certainly would be concerning. And again, that's why we want to be a little bit more defensive on our plays rather than playing for more of those cyclical plays right now. So think about stocks that will do better in more of a social distancing world. Think about stocks that will do well in terms of reshoring, in terms of moving manufacturing and moving different services back to the United States. Think about you know, the fact that we're likely not going out to restaurants anytime soon as quickly as we might want. So those types of defensive plays are the ones that you want to focus on. And also with volatility now spiking again, you might want to consider looking at some option selling strategies versus buying strategies. So with that, I just want to thank everyone. Oh, one last one, PayPal, e-commerce. So again, as a result of social distancing, we are more likely to shop online rather than go out to the stores to buy things that we need. PayPal has almost 100% exposure to e-commerce. They don't process any physical stores in terms of payments. So this is certainly one of the stocks that have been a strong contender since the start of COVID. And I believe that strength is likely going to continue. Fairly orderly move to the upside. So again, dips to the 20-day moving average have been good buying opportunities. So we're looking for a continuation higher here for stocks like PayPal. You know, there was some divergence here as the stock made higher highs, the momentum continued to move lower. So that is a concern, and that's part of why I'm unsure as far as how much higher the stock can move. So this is really, again, why we want to take more perhaps of a selling strategy, where as long as the stock stays around this 153, 155, and maybe grinds its way higher to 160, you're able to be profitable versus buying call options. You're going to need the stock to make a big move to the upside immediately in order for those strategies to be profitable, especially with option premiums being so elevated and a little bit more expensive. So with that, I just want to thank all of our members for supporting us and allowing us to continue doing this every Tuesday and Friday morning so that you guys can get an understanding as to how we're viewing the markets, both from a short-term, long-term perspective, as well as from a volatility perspective, why we are choosing certain strategies during our daily play. And I hope you guys may have noticed that, you know, 3-4 weeks ago, we were predominantly selling and we switched to buying because as markets started to rally, we wanted to participate in that, but we knew that there was a higher risk of a pullback. So that has worked out fairly well. Now that the market has sold off, we might want to switch and consider selling again. So these are the types of shifts that you need to make in your portfolio with your option strategy to make sure that you continue to position well for this type of new norm that we're currently in. So I hope that those of you that are not members yet will consider supporting us. It's just $75 a month or $500 a year to become a member. I'll post a link to everyone here in the chat window for you to look a link to how to support us and become a member. And with that, what I'll do is I'll try to answer a couple of questions here before I sign off. Do you still recommend closing a long position on AT&T? I believe so. AT&T, I don't think has bounced much this morning. It's bounced up 3% here. I still think that it's prudent at this point to cut losses on AT&T, because again, my thesis on AT&T was that this support level, so we broke out above that resistance. My thesis was that this was going to hold and bounce higher. That clearly did not happen. From my perspective, just the thesis was wrong, and we also breached our thresholds for cutting losses in terms of percentages. So yes, I do agree. I still believe that it's a good time to close AT&T. What are your feelings about financials? I think financials certainly bounced quite a bit today, right back to that 23. But I'm now far less bullish on financials because of yields. If you look at 10-year yields, they're right back into that range. So financials rallied with this increase in yields, and then came right back down as yields came back into that 70 basis point. So when yields are this depressed, that's going to be tough for banks to make money. So I definitely think that I'm much less bullish here on financials than I was a couple of days ago. Let's see. Is there any preferred time of day you like to put on trades? I generally put on trades in the morning, usually around 9:40, 9:50, 10 o'clock. That type of time is generally when I will enter and exit positions. But in the days of electronic trading, there isn't necessarily a good or a bad time to execute trades, to be perfectly honest. Add to Workday or in Cisco or sit tight. So Kel, I will say that if you only placed half a position in some of those names and you want to look at adding to those positions, you certainly can. But if you put on a full position originally, I don't recommend adding to a position, especially because at this point, those trades are still losers. Do I still like CarMax? I still like CarMax. CarMax is a very defensive play here, because as you see, auto sales have been particularly strong. What I love about CarMax is that it bounced very nicely off that 20-day moving average. That was the buy the dip opportunity that we saw. And that thesis is still valid right now. So I still like CarMax from a technical perspective, and I also like it from a fundamental perspective. What plays do you recommend on Zoom? Zoom has, let's see, I don't know where it opened up today. Zoom continues to move higher. This is supportive of why we're long Microsoft, or we like Microsoft, because of, working from home will continue to be a thing for substantially longer than we probably anticipated. The market showed us that yesterday. Okay, I'm trying to answer as many questions as I can, but I can't get to all of you. Microsoft July 190, 195 call is not a good call. First of all, a vertical spread of just $5 on a name that's $190, I generally don't recommend. I think if you're going to trade a vertical spread, you should trade a much wider vertical spread. But I would look at selling some premium here, maybe the 190, 185 or 190, 180 put spread. That will profit as long as Microsoft stays above 190. That would be my preference here. What do you think about Boeing? I haven't looked at Boeing, but Boeing certainly seems to have bounced off that 20-day moving average. But, especially with the market selling off yesterday, I think there was a bit of a reality check in terms of where we actually stand in terms of reopening. And I think the airline industry got a pretty big reality check yesterday. Things are not just getting back to normal as the charts were suggesting. And that was one of the things that we pointed out on Tuesday, was that if you look at the COVID-19 trends, the moves that we saw in the travel stocks seemed a little too far too fast. That's exactly what we warned about on Tuesday, and that was the pullback that we got. So I think it really took a lot of wind out of this rally. I think if anything, you might see a slow grind higher, but I certainly do not expect this to get back to that 230 level or so very quickly. I think it's going to be a much slower grind up there. So again, that's why my preference in this particular market environment is selling premium rather than buying. So with that, thank you so much, everyone. I hope that you guys find this useful in helping you start your Friday. I'll let you get to your trading, as there's a lot of things that are moving around in the market. So we will send out the recording to everyone here in a few minutes, and I hope you guys have a great day. See you guys next week.